would say the most important because it basically shows a firm's success in pursuing its goal, that is generating wealth for the owners, right? And we kind of stopped here with this matching convention, which is really about, I would say, the core of accounting. So what we usually do is we do not consider revenue and cost separately, but we try to match. So in order to determine the success of a firm, in order to determine profit. So expenses should be matched to revenue that help to generate. They help to generate. That means we always have this direct link. However, as of now, you should know that receiving or spending cash does not necessarily 100% overlap with what we regard as expenses and what we regard as revenue, right? So we need to be a little careful here, and this is what we look in more closely today. That's basically what I have on the last bullet points here. Applying this convention often means that an expense reported in the income statement for a period may differ from the cash paid for that item during this period. And this different view on what generates wealth is basically what we call accrual accounting, and in a few seconds you will see where this term comes from with these accruals. So let's consider an example where this plays a role. So here we have an example of an expense for the period that is more than the cash paid during the period. So in this example there's some sales commission to be paid. So it's a sales firm and the employees, they did very well, and now they get this additional commission on top of their regular wages, right? And it's 6,000 they kind of earn. However, it was only paid out 5,000. And how does this now map into the income statement? So we have a cash outflow of 5,000, but actually they deserved 6,000 for this year. And what's basically done is that a new element will appear on the statement of financial position on the balance sheet that we haven't talked about before, and that's what we have in this lower blue box, accruals or accrued expenses. So if you look at this graph, you see actually we have this sales commission, which is an expense, which is directly linked to the revenue that was generated in this respective period at 6,000. So in the income statement will show up an expense of 6,000. However, only 5,000 was paid out in cash. Yeah? That means in the statement of cash flows, there will only be a decrease in cash by 5,000. But what about the statement of financial position then? Something would be odd, because if you think what will happen to equity if you only consider the sales commission 6,000, if nothing else is considered, what about equity in the financial, in the balance sheet statement of financial position? How does a transaction, sales commission 6,000 affect the balance sheet, affect equity in the balance sheet? Yes, first what about the equity? How will it look like? Now just consider, think about a balance sheet you have, and then you have this one transaction, sales commission 6,000. How does the balance sheet change then, the equity? Yes, it would decrease by this exactly 6,000. And then we come to the second point we just said. it will not match because cash only decreases by, no, cash decreases by 5,000. So we have a decrease in the asset cash by 5,000, but a decrease in equity by 6,000. So you see the sums of total assets and the sum of equity plus liability will not match any longer. So in the upper part you decrease 5, in the lower part you only decrease you decrease 6. So something is off. Yeah. So we have this difference of 1,000, and how to deal with this? And that's actually what we have in this lower part. This is an accrual. Yeah. That comes up, and you see this at the right box, and it should also make perfectly sense as a current liability on the balance sheet, right? So in order to match this only 5,000, cash went down, total assets went down, we have to do something on the lower part, and here, I mean, it's basically something was not paid out yet, even though the employees deserved it. So it's a form of liability, but not against some provider of funding, but against the own employees, right? But anyhow, it's a liability, and it should also make sense that it's a current liability, because when they own this money, well, they expect to get it soon and not only in 2 years or so, right? So that's basically what happens. So we regard the whole sales commission as an expense because it was directly linked to the revenue that was generated in this respective period, and we do not only regard the 5,000 as an expense that was paid out. Yeah? But in order to keep up our basic equation that the sum of total assets is the sum of equity plus liabilities, we need to make this adjustment with the accruals as a current liability. And I mean, you see it here, how this will looks like. So this is just a general setting where you see where the accrued expenses or accruals will show up. But I can show you maybe a little more specific if you set up something like this. So what I did here is basically I used one of our previous examples. I do not know where it comes from, but we will find it in a textbook. It was one of the further examples. And then I consider this one transaction. So here I just have this example with non-current assets, property, furniture, and then current asset, inventory, trade receivable, cash. And now you can kind of fill in what happened. So we said cash decreases by 5,000, right? So this is 5,000. And we said that equity increases by 6,000, because otherwise this matching convention would be violated, because the 6,000 is related to the revenues earned in that period. And then you see, well, the whole thing does not match, as we just discussed. So the difference is basically 1,000, yeah? So total assets is higher than the sum of equity and liabilities, and that's why we need these accrued expenses. And you see, if we fill in the difference here between the decrease in equity and the decrease in cash, it matches again. So we have these accruals, accrued expenses, which are regarded as an current liability. Yeah? Okay, so this is actually how accounting deals with the fact that, well, revenue and cash inflows or expenses and cash outflows do not match within the reporting period. I mean, in the long run, this all should cancel out. Yeah? So this cannot be permanently part of the financial statements. However, as we kind of deal with certain time frames, this happens quite a lot. Yeah? Okay. Then, other examples where this happens often is rent that is payable, insurance fees, interest payable, and so on. So you see there are a lot of examples where something like this could happen. Okay, then next example where we turn this whole thing around. So the amount paid during the period is more than the expense of the period. Yeah? So what we have here is an example where some rent was paid or has to be paid for the whole year. That's the 16,000. However, there was paid more. So, yeah, basic example is the firm made the last rent payment December 30 or so for the coming next 3 months. Yeah? So the rent is actually an expense of January, February, March of the following year, but, well, the money's out already. We cannot keep the cash on the balance sheet of the current year, so we somehow have to deal with this. Yeah? And in the end, it's basically the opposite of what we just talked about. Yeah. So, statement of cash flow should be clear, 20,000 is out. Same for the balance sheet, cash decreases by 20,000. However, the rent expense, as it shows up in the income statement, is only 16,000. And consequently, equity in the balance sheet should also only be by 16,000 lower because of this transaction. And again, you see we have this mismatch, and 4,000 is the difference. But now, well, total assets decreased by 20,000 and equity decreased only by 14,000. So now we need to adjust, well, in the asset part. Yeah? Because, I mean, it's clear that this transaction does not affect liabilities or so. It's rather the other way around. You paid something, but you earned the right in the future to use these facilities you rented. So it's kind of an asset. It's something you have value of, right? And that's why we deal with such prepaid expenses as current assets. Yeah? So if you owe money, it's a current liability, but here, well, someone else owes you something. In this case, simply the right to use these facilities. And this is regarded as an asset, as a current asset, as it will be used soon, not only in 2 years. I mean, I said it, this rent was paid for January to March or whatever, right? So it shows up as a prepaid expense. And again, we can do it like this. Same balance sheet here. We said that cash decreases by 20,000, whereas equity only increases by 16,000 because that's the rent of the period. So you see it does not match. It's 299 total assets versus, oh sorry, you don't see it, right? Okay, now you get it. So 20,000 cash, 16,000 equity, this was what I've done. And you see the mismatch, total assets versus sum of equity and liabilities. So we need to adjust something. As I said, it does not make sense to adjust the liabilities because there is no liability stemming from this transaction. So we need to adjust somewhere here. and in the end what you do is you add these prepaid expenses, this difference of 4,000, so it cancels out again. So you see we have minus 16 here then in sum and minus 16 here, and this is how it should be, and this allows you to keep your balance balanced. Okay, and that's basically it. Okay, here just what we discussed, how this looks in general. So in order to balance, we need these prepaid expenses. This is now just some wording again. I mean, I had this on the previous slide also. In accounting, we really use this technique a lot, and well, this is why we call the whole thing accruals accounting, and this is actually what we regard as way more informative as the statement of cash flows. Yeah? Because if you apply this accrual accounting properly, you can really see what's the value that was generated within one period. What would not be the case if you would only look at cash, right? I mean, cash flow statement has its own advantages, but if you're really interested in the generation of wealth, you should rely on accrual accounting numbers and not on cash flow numbers. Yeah? Okay. Yeah. So, and well, as you saw, this accrual principle applies both to the income statement and the balance sheet. So these two statements are really based on this principle, whereas the cash flow statement, which we will discuss probably next week, does not. Yeah? But that's kind of a no-brainer, I would say. Okay, questions about this concept of accruals? Okay, then let's go on with depreciation. Before I go through the slides and we dig deeper, is depreciation somehow related to this accrual concept? Or what does depreciation mean? We talked a little bit about that before, yes? Sorry, I have to come up. Yes, you say assets use value. What do you mean by value? Yeah, so you need to be a little careful, because I mean a lot of people, they see numbers on the balance sheet and they regard this as the value of an asset. Is this what you mean with value? Real value, that's, what do you understand with real value? What's the value of an asset? Think back to how we discussed. How is an asset defined? So there was one important element that it classifies as an asset. I mean, it's exactly. So if you define value as something that generates economic benefits, it's totally fine. Yeah? But this economic benefit is often very hard to measure, right? And now to get the link to depreciation, you say you have an asset that provides you the opportunity to generate economic benefits. However, many assets cannot do this until infinity, right? At some time they stop providing this economic benefit. Let's, for example, take a car or so that might be used for 10 years and then it's just crap and you can't use it any longer. Yeah? And then the question is, well, I have this finite lifetime of this asset, as you said, right? And but how to deal with this? I mean, should I then say the value of this asset is, well, the price I bought it until it's scrap and then it's zero? Does this make sense? So the next step you should then think about is, well, how is this wealth actually generated? I mean, if we have this car, the wealth is generated by using the car. You can deliver your goods to your customers or whatnot, but you can only do this over some period, right? Over some time. Yeah? So, in the end, you somehow need to map the use of this asset to revenue that was generated over the lifetime of this asset. And that's basically what depreciation does. So if we have a car, for example, that costs, well, 100,000 and can be used for 10 years. Yeah? And in these 10 years, this car can help to generate revenue. Yeah? How should I deal with this costs I did spend once in the beginning when I bought this car? Should I say, well, I had this expense of 100,000 in the first year and then no expense for the next 10 years? Does this make sense? No, not really, because you use the car for 10 years, right? And that's why we have this depreciation. So in the end, we kind of divide these initial costs into parts, and the number of these parts equals the lifetime, the years this asset is used to generate wealth, right? So if you buy this car, for example, for 100,000, and you can use it for 10 years, you could say, well, the cost of this car in each year I use this car are actually 100,000 divided by 10,000 per year, and regard this as the expense of the car. And you see, if you do something like this, it's basically accrual accounting, because you do not consider the cash outflow when you buy this car for 100,000 in the first year, but you kind of consider, well, what's the cost of using this car over its lifetime, right? Yeah? So you have this detachment of the initial cash outflow and what you regard as the using costs. So you see, depreciation is a perfectly good example for accrual accounting. Yeah? And I mean, when we are at the end of this whole course, we will think about valuing projects, valuing firms, and there you will really see the difference, what happens if you make an assessment based on cash outflows, or whether you make an assessment based on accruals. Yeah? So, having that said, let me go over a slide. So most non-current assets do not have a perpetual existence, but have finite or limited lives. We just discussed this. They are eventually used up in the process of generating revenue. I had this car example, a car that can only be used for 10 years, but it also perfectly matches for some machinery or some buildings. And of course, you see, depending on the item you're talking about, this timeline might be longer or shorter. Then, there are different ways of using up. So, this car example, I mean, the car might be crap after 10 years and you can't drive it anymore, but things could also get obsolete. So we have this software example here. So probably you could use some software for a very, very long time, but at a certain point in time it does not make sense. So it's not that it does not work any longer, but it's just outdated. So you need to differentiate a little bit between their physical life and economic life. And for us, of course, the economic life of an asset should play a role. Yeah? So if something is outdated and it cannot probably be used in the daily business world, it should be depreciated by them. Yeah? So, in sum, depreciation is an attempt to measure that portion of the cost of a non-current asset that had been depleted in generating the revenue recognized during a particular period. Going back to my example with this car, the initial cost was 100,000. It was used for 10 years, so the idea is that you kind of divide this 100,000 over the 10 years. I made the simple example on that. I just divided by 10, which is perfectly fine. This thing is then called linear depreciation. There are other ways to depreciate, however, linear is a very common thing. If you think about cars, you could also argue, well, the decrease in value, if you regard value as what you could get when you sell it again, is in the first year much higher than in the current years. Then you could use some other form of depreciation, but we will talk about this in a second. So, points you should take with you is that depreciation is not first and foremost a means to adjust the carrying value on the balance sheet, and that's why I was asking all these questions about what value is, because a lot of people regard depreciation as an adjustment of balance sheet items, of assets. So you see the value of this car after 5 years, or the value of the machine after 5 years, but that's not the main point. I mean, that comes along with this idea that we allocate the costs over a certain period, but it does not really, is not really intended to kind of reflect the value of the car after 5 years, right? So that's something you should keep in mind. Last note here, we talked about depreciation. If it's about tangible assets, if it's non-tangible assets, we use the term amortization, but the construct is basically the same. It's just two different words for the same construct, but one applies to tangible assets and one to intangible assets. That's all. Yeah. So this IT software is actually an example for amortization, not for depreciation. Okay. Now, how to calculate this depreciation expense? In my simple example, what I had was the cost of the asset. I said the car costs 100,000. It's a cheap one, yeah. I mean, what you need to keep in mind is that it's not only the buying price you consider here, but there comes something on top, like delivery costs, installation costs, some legal costs maybe. So everything you need to put this item, this asset, in a state that it can really provide economic benefit of you. So for example, just buying a car will not help you much as long as you do not have license plates to be allowed to drive it on the street, right? And if you think about machinery you buy to produce something, this all needs to be supplied, installed, so this comes all on top. It's not just the buying price, yeah? What is meant by the costs of an asset. Then, the useful life of the asset, that's important. And I mean, I already mentioned it, we have to differentiate between physical life and economic life. So, yeah, well, the car can become rusty and just not drive any longer. Or it could also be the case that, well, you're not allowed to drive with it to the city center because only e-vehicles are allowed to drive in. So you could drive it in theory, but, well, you're not allowed, so the economic use is not possible any longer. So you see the difference. And for us, the economic life, which is usually shorter than the physical life, is the relevant one. Yeah? Because a firm or business would replace these assets by newer assets if the economic life is exhausted, and not wait until the physical life is over. And last point, and this is something I did not have in my example, is some residual value, some assessed residual value of disposal value. So if the business does not use this asset any longer, it might be the case that it can sell this asset and get something. And to go back to my car example, assume instead of the car costs 100,000 and is pure crap after 10 years, you could say, well, it costs 120,000. And after 10 years you get 20,000. Yeah? Then you have the difference between 120 and 20, which is 100, divided by 10, the useful life, and there you are, right? And that's basically how we deal with this. So, depreciation method. Just an example, straight line depreciation, as we already discussed. We need three pieces of information to calculate the depreciation expense. So the cost, then the estimated life, and the residual value. How do you calculate the yearly depreciation expense for this machine? Yep. Yes. So 78 minus 2000 divided by 4, that's it. And then you get a constant amount of money, which you consider as an expense in all 4 years. And this is then the carrying amount on the balance sheet that decreases by this expense. And you see, it perfectly makes sense. It fits to our rule that the balance sheet needs to balance. If you consider this depreciation as an expense, your equity goes down by this expense, with 19,000. Yeah? However, you somehow need to adjust the assets, and that's why from the costs you deduct this 19,000 yearly. So that's how it maps both in the income statement and in the statement of financial position. And as I said, this does not really match the value of this asset, but it somehow, yeah, kind of adjusts for this use. And of course, if you compare financial statements or compare balance sheets over time, you might get a feeling whether a firm invests or kind of is a little sloppy on investments. So if non-current assets go down for several years, this is a clear sign that there was no investment, that there was no replacements of older machinery, yeah, but only depreciation kicked in. However, if it stays relatively constant, you should realize, well, there is depreciation, of course. However, the firm invested in newer machinery as well to cancel out this depreciation, right? So this is how you interpret this. But, well, the math itself, the technique here, that's kind of, yeah, an easy thing. Then there's this other way of depreciation, reducing balance method. So the idea here is that you deduct a fixed percentage rate of depreciation every year. So we have this example here. Depreciation is 60% of the carrying amount. without showing you the numbers. I mean, we had this straight line depreciation where the depreciation amount was the same over all years. What happens here with the amount? I mean, the percentage rate is always 60% of the carrying amount, but what about the depreciation in monetary units? It's not constant, right? But
every year it decreases?
It decreases every year, right? So you have a relatively high depreciation in the first year, and then it gets lower and lower over the years. And as I said, this might kind of match the, well, ability to generate wealth. However, yeah, it's a little bit of a stretch to find an appropriate depreciation rate. I mean, it might make sense if you think about, well, reselling value, but as I told you, this is actually not what depreciation is intended to show. Yeah? That's not what this is about. So it's a little hard to justify this way. However, do you have an idea why some firms might like to do this anyhow? What's the advantage of having high expenses in the beginning and lower expenses later on? Pardon? It makes your income? Yes, it kind of, yeah. So the answer was it makes your income looking like it goes up over the time if you only consider this case. Yeah, no, this is a valid point, but it's not what I had in mind. But it's valid, yes. Less taxes, yes, that's basically the thing. So, I mean, financial statements are not tax statements. These are two different things, but they are highly aligned. And usually, if you choose one type of depreciation for your financial accounting, you also have to apply it for tax accounting. And this leads to the fact that in certain years you have or in the first years you have a relatively low income. As you said, it will go up, but consequently it means in the first period it's relatively low, right? And then you pay low taxes. Of course, later on you have to pay relatively more taxes, but if you kind of consider certain tax schemes where you have to pay more taxes if you earn good, this could make a benefit for you. So for taxing reasons, this is sometimes used. Give me just a few more minutes so we can get through with this. This is just the calculation. So what was done here is you basically take 60% of this cost of the machine and depreciate it to this residual value of 2,000. And then, last slide before the break, there's this formula in the textbook where there's a typo, how you can calculate the depreciation percentage. If you know these three elements we had before, we needed to calculate the straight line depreciation. That was, we had the useful life, we had the cost, and we had the residual value. And with these three elements, you can calculate, well, the percentage rate that leads to, starting from the cost to this residual value. Let me quickly go back. So you see here this example is set up in a way that with the 60% deduction of the cost of the machinery after 4 years, you end up with the 2,000. But that's not that easy to see, and usually you only have these three pieces of information. I told you, cost, residual value, and useful life. And then the book says you can use this formula. If you look it up in the book, the times 100% is in the bracket, which makes it wrong. so it should be out of the bracket. However, I think it's no use to learn this by heart, because I think to think about how you get to this formula is way more useful, and that's what I put you in this lower formula here. Can someone, look at this formula and then we talk about it after the break, yeah? Then I want you to interpret it and tell me what's standing